Good afternoon and good morning, good evening, wherever you are in the world, whether you're watching this live via our Facebook stream or whether you're watching this via Zoom. We welcome you to our Getting Financially Fit to Return webinar. This is designed for South Africans all over the globe that are thinking of relocating to South Africa, learn about the things that they should be thinking about before they make the big move back home. It's also designed for other nationalities that are thinking about relocating to South Africa and potentially making it their home. We help all different types of people. Please feel free to connect with me on social media. All of the details are here below. And feel free to reach out should you wish. During the session, you can also scan this QR code and send us a WhatsApp that we can actually respond to live as we're going. So for those that don't know me, I'm Mark McAllister. I'm Senior Partner for Holborn, based here out of our Cape Town office, and I'm broadcasting live today from our new Somerset West office, here to answer any questions that you may wish to have covered. Hopefully we'll get through a lot of it today. And here is what we're hoping to cover. Number of key points that are raised regularly by those that have gone before. But there is a section at the end for answering questions. And I would like to request that you utilize the Q&A button at the bottom of your screen to type any questions that you may have, and I'll do my best to answer them as we go along. Okay, so let's get started. So let me give you a bit of background about our business by way of introduction. Holborn Assets is one of the longest established, independently owned family financial advisory businesses in the world. So we've been around for over 25 years. We were established in 1998. We've got about $3 billion under management and administration, with clients in over 30 different countries and offices in over 11. And over 2,000 happy client reviews on Trustpilot. Feel free to Google us and check us out. So why are you considering a move to South Africa? Well, first, I want to say that you are not alone. There's a number of people in exactly the same boat as you and thinking about making the move back to South Africa. Fundamentally, it's home. It's normally where family are. So that's the first primary reason that people make the move back. The weather is awesome. I say that in the summer here in South Africa, it's very easy to fall in love with it during this time of the year. The winters have been a little bit challenging the last couple of years. Prior to that, maybe a bit better overall. But certainly there is a proper summer. And I have to say that's one of the key reasons that I live here for the majority of the year, and why a lot of our clients also spend most of their time here. Weather is fantastic. Quality of food is amazing. Really have to point this one out for those that haven't been back for a while. It makes you realize how much of the sort of processed and homogenized foods at very expensive rates sort of permeate through the UK food system, if that's where you're coming from. And big houses and help at home. So if you're crammed into a tiny house, you're fed up of doing the cleaning, the washing, the ironing, and all those things, it can make the whole existence sometimes quite challenging in a place like the UK. And all of these points and more are why people often think about relocating. To cap all of that, the cost of living has been consistently somewhere in the region about 40% of the UK. Obviously, the exchange rates do move. But let's just give you a bit of a heads up on that. So at the moment, we take an average cup of coffee out of Costa, £3.95. Today, that is 91 rands. Let's go for our equivalent here, which is Vida. Some of you might remember this or have been there before. A 45 rand grande cappuccino, £1.96. So significant difference in the equivalent like-for-like cost of living. One of the questions I often ask is, if you've got a role where you could live here but continue to earn in pounds, US dollars, or euros, why not consider it? There's a number of elements to that, and a number of clients that we have that do that. Your retirement income could be paid to you with zero tax, and that's one thing that, as a longer-term strategy, a number of clients think about. You do the same retirement, same funds, but you have a lower cost of living here in South Africa, and on top of that, potentially don't pay any income tax. It's a win-win situation if you're here majority of the years and meet the definition of a South African tax resident, but we'll talk a little bit more about that later on. And did I say, again, that the weather is awesome? I still have to come back to the main reason that people come back as family, but yeah, the weather is something that's worth reiterating. But there we go. So that's some of the reasons why you might be thinking about this decision. And like I say, you're not alone. So if you've resided abroad, then it's recommended that you work with somebody like myself that has experience of both the previous jurisdiction where you are, but it's also internationally qualified to be able to provide advice in the jurisdiction that you're moving to. So number of elements to that, a number of different jurisdictions, number of different countries that people move back to South Africa from. And thankfully, we've got experience across the board and we've got offices in virtually all of these territories as well. I myself am qualified to the UK standard with the Chartered Institute of Securities and Investments. So that's the leading industry body in the UK. And also qualified to provide financial advice here in South Africa. So, able to provide experience from abroad, but also the financial regulations requirement is met here where the advice is often provided. So then that's a bit of our background. That's who we are. That's what we do. Let's move on then to what should you be thinking about? Well, all of this will start with some element of a financial plan. So let me take you through the basic steps that we as financial planners generally follow. It's obviously very different client to client, but generally speaking, we normally follow these sort of 6 steps. So the first thing first is assess your financial position. So look at where you are right now. You might be in the UK, you might be somewhere else, and look at your financial position. And that starts off with creating a budget. So that's what you spend and what you earn. So it's kind of like running a business. You have top line income, the cost that you expend in the middle, and what's left over is your monthly surplus, or if it's a business, it'd be your net profit. You might then start to try and work out whether you would have similar income streams if you move to South Africa with a lower cost base, potentially. And all of those things need to be factored into your thinking before you make the bold decision to move back. As part of that, setting your financial goals. So, not losing sight of the fact that most of my clients set out a very clear goal, which is, we should be aiming to work not because we have to, but because we want to. So true financial independence is something that a lot of people aspire for, but don't actually achieve. One of the things that you can potentially do by moving back to South Africa is lower your cost base and potentially get to that financial independence sooner. So as part of that, then knowing your risk tolerance. So, what can you realistically risk? And risk isn't all bad. So just to be clear on that. Sometimes the biggest risk is no risk at all, longer term. So I know a number of clients that just want to try and get to their goals by saving in cash. It's definitely a way of doing it, but sometimes you'll struggle to achieve certain goals if that's how you approach things. So knowing your risk tolerance is an important part of that process. And then part of that is then working out and implementing that plan. So step by step, knowing what you need to do to achieve this move. And then once it's in place, regularly reviewing the financial plan. So whether you involve a financial planner or a specialist like myself, or whether you choose to try and do this yourself on a DIY basis, these are the key steps that you need to think about. So one of the first steps is understanding, what are your assets and what are your liabilities. So simply put, your assets are things that you own, and your liabilities are things that you owe. So quite often, that will start off with things like your main property where you live will have a value. That's an asset. You've probably got a mortgage on it. That's a liability. So if you were to sell it tomorrow, you're going to have hopefully some money left over. What we would call the equity in the property after costs of sale, things like estate agents' bills and capital gains tax if it's an investment property could apply. All those kind of things. So that's an example of an asset and a liability. You might have things like cash in the bank. You might have some investments that you personally own in things like ISAs or pensions. You might have directly owned investments as well. You might have things like credit card debt or other loans. You might have money that you owe to the tax man. So that's another example of liabilities. But what you do when you create a balance sheet is really take what you own, your assets, remove what you owe, your liabilities, and then you start off with a figure of what you are worth on paper. How much do you then take back? This is one of the first key questions that I often get asked. About should I take all of my pounds, all of my dollars, all of my euros or Swiss francs and or dirhams and move it all back to South Africa? And quite often the rationale about that, the first thing is, oh, but this is, the interest rates in South Africa are so much better. Yes, they are, but also you're then introducing a new currency risk, so what happens when the rand depreciates, and we'll talk about that now. So before you even get into the mechanics of that, what you're taking, the way I would position it is like this, stand back and think about the future of South Africa, and with your experience, your knowledge, as probably a citizen of this country, where, if you were to say, right, in 20 years' time, where do I see South Africa from 0 to 100%? Okay, where would you place it 20 years from now? What do I mean by that? Well, let's say the 100% scenario is best case. I often refer to this as like the Singapore scenario. So, the South African government has got it really, really right. It's the next world superpower. There's no corruption. Everyone's got a job. I don't know, the rand is 4 to the dollar, something like that. So the best case scenario, like Singapore, very poor nation in the sort of 50s and 60s, has developed into an economic powerhouse. There's other examples around the world, but that's really the 100% scenario. What's at the other end of the scale is, the sort of failed nation state scenario, the worst case scenario. I often hear people, banding around. You can say, for example, Zimbabwe might be a good example of that of old. Venezuela in South America. There's lots of examples. And what do those countries look like? Well, they normally have, poor governance issues. They quite often have challenges around things like, inflation. So they might have high rates of inflation, high rates of unemployment, and all those kind of economic challenges. So, what I'm asking is, what do you think is the future of South Africa? What do you think its chance of success is from the 0 to the 100% scenario? And what is that number? Where do you place it between those two numbers? Why is that relevant? Well, because if you say to me, Mark, I'm 100% focused on the future of South Africa, I think it is going to be the next Singapore, then absolutely, you should take 100% of your money and put it into South Africa. That's what you truly believe. Then why not? If you firmly believe it's going to be that great, then it would be wrong to think about investing elsewhere, right? But most people, generally speaking, will come out slightly lower than that. And then what my general rule of thumb is, then we'll think about how much money do you need to keep outside of South Africa in alternative investments, in alternative currencies, to match, kind of how you feel. So that might be 25% offshore, might be half, it might be 75% offshore. It might be, near 100%. I've got a lot of clients here that come from abroad and they live in a property here, but nearly everything is abroad. And it's the old adage I use, invest where it's cold, but live where it's warm, and let the currency depreciation, the challenges that go on here work in your favor if they do carry on. And that's the question. But bottom line is, it's not my job to steer you on that. It's your decision. You should hedge your gut and do what you think is right. And then we start to build the financial plan around that gut feeling. Let me just give you a little bit of history, because quite often this is the first thing that we talk about is that, shall I bring a load of pounds as an example down to South Africa? Why? Because, we're north of 20 at the moment, have been for quite some time, sitting at about 23 today. When I came to South Africa, we were 15.45, and that's how much it's depreciated over that time. So there is a common misconception that this has only happened in the last 5, 10, 15 years. No, this is a long-term trend. We see this in a lot of emerging markets. Why do we see that? Well, it's because of the perceived risk of an emerging market currency against its primary currency pairs. So you can literally see all the way back here to 1980, how much the rand is depreciated by. Though it's not a hard and fast rule, when the currency is above the dotted line, one would argue, that actually buying rand might make sense. When it's below the dotted line, though, potentially the other way might be true. But generally speaking, it normally comes back to that trend line, and that trend line is only going in one direction. So you need to think about that from a rand-based perspective. That rate of currency depreciation means that you've got to outpace that in the very least, and if not, then you might find yourself significantly poorer in the longer term. There's no real change when you look at the dollar either. The dollar itself has been very, very strong over the last few years, particularly in this recent period of high interest rates. Starting to weaken off a little bit now, but still the principles are the same. So whether you look at pounds, whether you look at dollars, the rand will probably continue to depreciate unless it dramatically improves, and that's really gonna a gut feel. So what you have to ask yourself is, do you think things in South Africa are going to be about the same? Do you think they're suddenly going to get a lot better, or do you think they might get worse? And that will probably then translate into the share price of South Africa PLC, which is its currency against other nations. But we'll see what happens in the coming years as interest rates start to reduce, or it appears that they're likely to reduce over the coming months and years. What else should I think about? Well, diversification is a key investment strategy. Don't have all your eggs in one basket. I'm sure you've heard this before if you had a discussion with a financial planner in the country that you're in currently, or maybe you've just thought or read about this before. Don't have all your eggs in one basket. It's a very well-known saying. So even in the event of a worst case scenario, you may need to access some kind of ring-fenced offshore investment. If you think the worst case scenario happens in South Africa. One of the challenges about investments in South Africa is that many of them will involve your investments having to come out via South Africa, and thus subject to a thing called exchange control. That might be not something that you're used to if you've been in the UK all of this time, something I had to learn about, which is that the government will actually stop you from sending money out. You've got to ask permission before you send money out of the country. And that's something that therefore puts a physical barrier, and if there was some kind of inflationary event, you might find yourself stuck on the other side of the equation. It's currently 1 million rands per individual without certification, and then you can get another 10 million per individual with clearance from SARS stroke the Reserve Bank. It's a process called AIT. Annual levies are subject to change by the South African Reserve Bank. There was talk about that being scrapped, and it still hasn't happened yet. So let's wait and see what's on the horizon for South Africa, but it's still in place as we stand at the moment. Okay, so retaining a UK bank account. Can I retain a UK bank account? Yes, you can, within reason, and within certain cases, certain providers may or may not allow it. So why would you want to? Well, it's ideal to allow you to still have some pounds, euros, dollars in an offshore account. It's quite often a good idea to keep a SIM card going in that country if you need to receive one-time PINs for things like government gateways, for accounts that you may have, and security purposes. So again, I'd encourage you to think about a very cheap SIM card that you then run through that account, and so that you have that as an option. Retaining a UK SIM also, I'm sorry, I've just covered that point about the PIN numbers. And generally speaking, the challenge that we find is that the legacy banks in particular are not keen on having overseas residents on their UK-based books, particularly South Africa, which is deemed a high-risk jurisdiction. So Barclays Bank, as an example, very, very clear on this. They will not allow non-UK residents, South African residents, to retain their bank account. What they expect you to do is shut your UK account and instead open a bank account overseas with their international business, which normally requires a minimum capital of £100,000. What I would recommend that you think about is setting up one of the digital banking apps, the likes of Revolut, Wise, or Monzo. Generally speaking, they're a lot more flexible. They work really, really well with things like digital verification apps, that sort of thing. If you've got a UK property and you're planning on renting it out, you need a bank account to get rent into. So that's the one that, or the route that I normally recommend for most clients to set up before they actually leave. One of the things that I'd encourage you to think about out of the three, if you're looking for one to try, Revolut, it's free to set it up. Over 45 million users, free to join, as I said, and you can sign up with a link below and stand a chance to win a prize at the end of the year. And here's the code now, and I'll share it in the chat as well. So good luck to all those that join via that free referral code. Okay, so that's digital banking and banking options. Let's talk about retaining property as an investment. And this is a bit of a hot topic at the moment. Why? Because we're just in the process of seeing a change around the corner thanks to the Labour government. But we wait with bated breath on where they plan to raid first. Regardless of that, property as an investment, particularly UK investment property, is without a doubt one of the best investment categories that you can or own long-term for long-term wealth growth. Why? Because if the asset goes up in value, you can borrow money against it. You've probably read the book by Robert Kiyosaki, Rich Dad, Poor Dad, and he often talks about the virtues of and growing your property or your wealth through leveraged property. And if you're leaving the UK, can you do so and maybe make it more tax efficient? There's a number of options that you can look at about owning investment property, through things like a limited company, some very specialist pension funds as well, depending on the amount that's involved. But why not attend one of our more detailed future seminars on being an expat landlord, or just drop me a message and I can talk you through how others like you have navigated this quite easily. And things like overseas borrowing, how do we sort out mortgages for expats, that sort of thing. Okay, moving on. One of the things you need to learn about, or be aware of at least, is the dual tax agreement. So what is a dual tax agreement? It's when two nation states agree on how tax matters should be handled when you have a resident that's got a foot in both camps. The principle of a DTA, as they're called, is that you shouldn't pay tax twice. It doesn't mean that you shouldn't pay tax at all. It should mean that you don't pay it twice. But you still owe someone for something, around how you're taxed. And there's a number of nuances here that we work with a number of providers on to help clients understand what their tax position is. For example, foreign residents normally have a number of years before they would be deemed to be South African tax resident. However, if you're a South African that's returning and selling everything up, moving back here, potentially that might happen sooner if you are deemed to have returned from your international wanderings. And if in doubt, this is where we bring in one of our specialist tax consultants to clarify exactly what your position could be. One of the things that I often hear is, wow, how are they going to know? Well, just Google common reporting standards. One of the things that all of this technology we now have hanging off us in daily life has meant is that governments are actively sharing information about you and what you do with other governments. So CRS is the legislation that a number of OECD nations have signed up to. And if you've opened any bank account with any financial institution, normally with your passport, then you are on a database somewhere. So if part of your strategy is you hoping that the government won't know about the investment account you have, insert jurisdiction here, that's not a great strategy to apply. It makes much more sense to discuss how you're structured with a planner and a professional like myself, and we can talk you through what are the risks associated with not declaring what you have in place. But so that's all the doom and gloom side of things. Let's focus on some good news. South Africa is still one of the most tax efficient jurisdiction for people drawing foreign pensions. Why? I won't bore you with all the detail on this call. We do a separate session on it. But under the South African Income Tax Act in section 10.1 GC-2, so a bit of a mouthful, you're able to access foreign pension income of the right type, and not pay income tax in South Africa. There's a lot that goes into making that happen, and I'll talk about that in a bit. But generally speaking, that's why so many pensioners choose to retire to South Africa, not just because of the cost of living, because actually it's a very tax efficient jurisdiction if you are structured correctly, and that's where people like me come in to assist you. Let's just, sorry, I've just got a bit of an issue here. Let me just move on. So what would your ideal retirement look like? Let's just talk about that, understanding where you think you would fit in, and what it's going to look like. Have you got sufficient retirement provisions in place? Regardless, the earlier you start, the better. So if you haven't got something in place and you're moving back to South Africa, well, potentially what we need to think about is an alternative. When it comes to retirement planning, though, it's pretty straightforward how we go about doing that. We set a goal, whatever that goal will be, and that's normally focused around how much you need in retirement. We then look back to today, and that gives us a time period to work with to get you to that goal. The longer the time frame we have to work with, the more time means smaller steps and then much more manageable. However, if we leave it longer and therefore we have less time to work with, the steeper those steps become, the bigger those steps are required to make it to our goal. Leave it too long, and the mountain is almost impossible to climb. And that's one of the things that I would really encourage you to think about. If you haven't got a financial plan in place, having the discussion with us when you're back in South Africa, we might be able to come up with some alternatives that you've not thought about or not been able to discuss whilst you've been abroad. But there's an age-old saying, which is, the best time to start saving was 20 years ago, and the next best time to start is today. So whether it's retirement in the traditional sense of the word, or the more modern discussion, the way I approach it is financial freedom. When are you going to be working? Not because you have to, because you want to, and putting some thoughts around that. When it comes to anything like that, though, longer term plans, we need to think about a number of aspects. So things like your risk profile is arrived at through an understanding of what is the risk that we need to take, but your capacity and your risk tolerance, all of those factors combined will then start to impact on what we can do. And as you move through life, there are different stages to our lives that therefore can impact on what we should be doing, or what we can realistically do in the time that we have left. And each phase has different needs and different goals. Whilst you've been abroad, particularly if you're in the UK, which is where the majority of people that come back to South Africa are from, it's quite likely you'll have paid into a private pension scheme. And after your property, this is likely to be your second biggest asset. One of the things you might have heard of is that you could transfer it to a different country. But in March 2017, so 7 years ago now, the law changed literally overnight with a budget. And it basically said that if you wanted to take your pension out of the UK to somewhere more favourable, but you don't live there, you would have to pay effectively what they called the exit tax, a 25% exit tax. Obviously, that was perceived as a way of reducing lots of money, disappearing out to other jurisdictions beyond the UK government's control. But this is a really relevant question today as we look down the barrel of the proverbial shotgun. A week from now, the first Labour budget in a number of years, and the general consensus is we are to expect some form of a raid, as they're calling it, on pensions in the UK. It's too late to do anything right now, but one of the things that I regularly review with clients is, do we want to, or do we need to think about alternatives or options that protect you from government changes in the future? There's one thing that you can be certain of, that the tax law and the government policies will change without a doubt. The other thing to think about is the UK pension system is under significant strain. That's why it's an option to tax. mainly because of the aging population, low interest rates historically, and quite often poor pension performance. A lot of schemes have been in deficit. So, do you want to risk your pension being devalued by, choices that are made that side? Number of companies have failed historically that contribute to pension schemes, and it's impacted on pensioners who have done the right thing historically and just want to provide for their family and themselves in retirement. And so one of the things that I encourage you to think about is at least understanding exactly what you have in place and what it means for you when you're back in South Africa. How do we assist you with that? Well, this is where what we call our free pension MOT service comes in. So a number of questions that I would ask you if we're having this discussion face to face. Who's your pension with? Quite often pension books get sold from company to company. If you think you're with Scottish Widows, you're now with Aegon. You think you're with Aegon, you're now with Standard Life. And it can be quite complicated to understand where your pension is actually sitting in the world. Do you know how much it's worth today? So you might not have looked at it for quite some time. Has it gone up? Has it gone down? Has it gone sideways? But what is it worth today? It's your second biggest asset. How often are you looking at it? Then, do you actually know what it's invested in? Most people know that it's invested in the XYZ fund or the ABC fund. But what does that actually buy? What does it own underneath it? Has it got investments in it that are performing well? Or is it invested in things that you're comfortable with? If you have a need or a religious belief or an ethical or social responsibility belief, you might find that you're invested in companies that are completely opposite to what you want and your investment portfolios. So if you don't know what it's invested in, actually the companies at the underneath it all, then actually maybe you need to think about looking at some alternatives. How is it performing against its peers? This is probably the most important question of the bunch. People have pensions, forget about them, 10, 20 years ago to pass, and it's gone up a handful of percent. And why? Because maybe they weren't in the right risk profile, the right investments for them, and actually it's ended up in lackluster performance. So how fast is it going in its peer group? Is it at the front of the pack? Is it in the middle of it? Or is it right at the back? And that's one of the things that's a key question to understand. And therefore, once we understand all of that, what will it be worth in the future? If we project it forward with its performance and its costs, what's it likely to be worth down the line? To achieve, with all of those questions, if any of them you've thought, no, I don't really know that, being honest with myself, then it makes sense to use our free pension reconnection service, our pension MOT, as we call it. Let us look under the bonnet and we'll come back to you with some thoughts on it. What it involves is a letter of authority just to receive information. We don't make any changes. We don't go swapping the engine around or anything. We literally have a look under the bonnet, come back to you with a report. Why is it important? Well, with the correct UK pension, you could receive pension income in South Africa tax-free. If you've not got it set up correctly, the UK government could take up to 45% of your income at source when you retire. And if you want to remove it outside of the UK, you could end up paying exit charges of between 25 and 55%, depending on how you do it. So be very careful around those kind of options and thoughts. I often refer to the pension vehicles as vehicles, and is it, if you were driving from London to Cape Town as an example, are you going there in a tank? Something that's bulletproof, it's going to make it, no issues at all. Is it a car, the same as everybody else, doing 50 odd mile an hour in the middle end of the motorway? Or are you in a jet fighter that might be far too risky, far too expensive, will get you there quickly, but could fall out of the sky? And that's why it's important that you understand exactly what you've got and the risks associated with it, and whether it meets your risk profile, the bit that I was talking about earlier on. If you're sailing, if we use again another vehicle-ish kind of analogy, it's a little bit tenuous, but if you were sailing to your destination, you were just off course by a few degrees, where are you going to end up 10 years down the line, where you could be significantly off course? And that's one of the things that we encourage you to think about when you review your options. So if you're also coming back, or you are back already, you don't have a foreign pension but want an offshore tax efficient solution, you like the idea of everything that I've been saying so far, Well, let's first of all consider some of the reasons why you should. So, do you want to have investments in currencies other than rands? So you want something in pounds or dollars or euros. Do you want investments not impacted by government decisions in South Africa? Things like the coalition government, things like future governments and what goes around with all of that. Do you want investments that offer you everything from gold to property in one efficient solution? And do you want investments that pass seamlessly to the next generation outside of your estate, so you're able to leave those to kids, grandkids, and others without it being a huge problem? If you answered yes to any of those questions, again, it's worthwhile speaking to us. That's the majority of the business that we do here in South Africa, is helping people to ring fence investments away from South Africa and grow them in primary currency in exactly the way that I've described there. Lastly, again, coming back to sort of the DIY route, or maybe something to start help the creative juices flowing, we've got a free budgeting tool, and it's completely customizable to what's going on and potentially where things are going cost-wise, with some suggested things you should think about, and the costs associated with it. So if you're looking for a budget tool to start with, set as a family of 4, but it can be customized either way, just drop us a message and we'll do everything we can to get that over to you as soon as possible. Well, I hope that's been worthwhile. Certainly a number of people are thinking about making the move back. So if you've got any questions in specific areas that I haven't covered in this very general broad brush presentation for today, then don't hesitate to connect with us via social media. Feel free to drop me an email or a WhatsApp, pop into the office over here, one of the other offices in the Western Cape. We've also got offices in Johannesburg, Durban, Paarl, and Cape Town Central as well. And like I say, it doesn't cost anything to have a discussion with us. We'll have an introductory meeting with you free of charge, and we can talk through what your thoughts are and benefit from the experience of several hundred other expats that have followed you and are current clients of our team here in South Africa. Okay, we're going to move on to the Q&A section now. So if you haven't already done so, feel free to ask a question using the Q&A button. It's at the bottom of the screen on Zoom. And you can just type in a question there and I'll do my best to answer it now. If you want to send one to me via WhatsApp, you can just scan this QR code that's in front of you now, and that will allow you to send us a message to where I'm online here at the moment. Okay, let me just stop sharing that. There we go. All right. So first question here I've got from Johan. Johan, thank you very much for your question. One of the key ones that I often get asked, the pension income and getting that tax-free in South Africa. Sounds too good to be true. Yes, I can tell you a little bit more about that. Okay, so with UK pensions, they're currently designed for access normally at age 55 if you have a typical defined contribution scheme. If you have a defined benefit scheme, it might be slightly later in life. But when you take that income or when you draw down on your pension, you normally have 3 choices. You can go and buy an annuity, very similar to the South African system, but you can also withdraw it in chunks, so what's called drawdown, or you can actually withdraw the whole thing, which is full flexi access. Doing so will attract income tax. But the key point is the UK will give the taxing rights under that DTA that I mentioned earlier to South Africa. South Africa chooses not to tax those. And like I say, the exemption, that 0% exemption, has been in the Income Tax Act for a number of years. The most recent update we had from SARS is a general binding ruling, so that applies to everyone in South Africa, dated March 2017, I think it was. So again, that's been in place for a number of years, and it doesn't look like that's going to change anytime soon. So yes, what we would encourage you to do is apply for the appropriate paperwork with SARS and HMRC, and then your pension income can be paid to you tax-free from when you can access it. So currently age 55 for most schemes. From 2028, that's likely to rise to 58. Sorry for people like me in their 40s. We've got to wait a little bit longer but statistically, we're likely to live longer anyway. So there's some good news there. So yes, it's not made up. It's absolutely true. You can live here in South Africa on pension income and not pay a cent in income tax completely legally. And that's why so many expats retire to South Africa. So happy to help you with that, Johan, if you want to ask some further questions. Okay, moving on to the next one. This is from Steve. Just explain how taxation works on rental income for properties that are overseas. Yeah, look, a little bit challenging for me to do. I'm not a tax consultant. I deal with this sort of stuff all day, every day, and I have a number of tax consultants that I work with that can provide you formal advice on your situation. What I can do is just give you very general information only facts, really, that you could probably find on Google yourself. It's quite challenging there. I understand that trying to interpret everything and all the different opinions is quite challenging. So generally speaking, the most important thing is understanding, firstly, are you a South African tax resident or not? Okay, and as a person that's been through this process, generally speaking, it takes about 5 to 6 years if you're a foreign national that moves here and lives here all the time. And that's the physical presence test. So there's 3 parts to it. You need to have been in South Africa for at least 915 days over the previous 5 years. You need to have been there at least an aggregate of 91 days each year over those 5 years that are assessed. And lastly, 91 days in the current year of assessment. So if you tick all 3, not just 1 or 2, all 3, then you're almost certainly going to be deemed a South African tax resident. And therefore, your primary government that you have to report to, or primary revenue authority, is SARS, not HMRC. If you're still reporting to HMRC and you have paid tax there, then what should then happen is that there's a netting off with what you paid in the UK against what you should have paid in South Africa. So by rights, you'd fall into the same category. No different to South Africans that have never lived, that buy investment property, and we've assisted a number of clients to do that over the years. As a foreign landlord, you get paid the income gross, and then you put it on your income tax return here in South Africa. You deduct expenses in the pursuit of that income, and then that's how it works. So very, very simple income tax principles. One of the key things, though, that is different is that actually you can claim interest against your mortgaged property if it's got an interest only, or any mortgage that attracts an interest payment, that can be deducted as an expense in South Africa, whereas the UK currently don't have that. And I say all of this currently with a very much a proviso that next week the government are about to no doubt change a number of elements of the budget. And what are we expecting? Well, I don't want to, be a doom-monger, but it'd be much better to have another session. I am doing a session on the budget online in about a week's time. But on the property side, what's muted and expected is a significant rise in capital gains tax. Capital gains tax would apply if you have an investment property that you sell and you're still a UK tax resident point of sale. Does it mean you should go and sell your property today at a loss? No, unfortunately, the time has passed. We need to just let the government do what they're going to do now. And that's one area where things might potentially change. Another area that's likely to change significantly is how pensions are taxed and treated. And again, we'll cover this in that specific webinar. There's a lot of sort of word around the campfire, as I call it, within our industry as to what they may change, but we don't know for definite what they will be changing. Like I say, please tune in next week when we do our budget webinar. If you need the details, just ask for it in the comments below. Okay, I don't think there's any other questions in the queue. I don't think I've got any on WhatsApp here, apart from ones we've already answered. So if you haven't got a question, or sorry, if you have got a question, apologies, please do ask it now. I'm just going to put up our contact details one last time. So if you want to reach out to me, feel free to do so. Thanks again, ladies and gentlemen, for joining for this very brief overview on the things you need to think about to be financially fit to return to South Africa. I hope it helps. If you need assistance, please don't hesitate to contact us, and stay tuned for future events by following us on our social media channels to learn more about this exciting decision that I hope that you will be making soon. Ladies and gentlemen, thank you very much for your time and hopefully speak to you soon. Take care.